Welcome back to the channel, friends. Today I want to share with you another update to my portfolio that I'm going to be doing, and that's actually selling two of my last remaining REITs, real estate investment trusts, which I've been holding for quite a while, but I finally come to the conclusion that it's time for me to sell it off. So in this video, I want to show you why I'm selling them and of course, take you through the process and also show you, of course, what I will do with the proceeds from the sales and what I will be investing in. So without further ado, let's get started. So here we are inside my Interactive Brokers portfolio. If I click into the holdings, you can see I really reduced my holdings over the years. I, not so long ago had way more holdings, individual shares actually. And yeah, I just didn't feel comfortable with that anymore. A, because the time it took me to research them and stay on top of all those holdings. And B, actually a lot of them were underperforming. So you can see now I'm left with only four. The first one is my ETF of choice, the S&P 500, which I buy. And then you see I only have three holdings left. And today I want to reduce two of them, which is O, which stands for Agree Realty, and Vici, which is another real estate investment trust. I still leave Pfizer in there. That's maybe a topic for another video in the future. But basically why I'm selling them now, this is maybe not the most sophisticated approach, but actually I told myself quite a while ago when they were really down in the minus, I said, I don't want to sell them at the minus. It was just a psychological reason. So I was waiting for them to return to plus. In the last few months, they actually increased in value despite the previous months being really very much down. But in recent times, as you can see, I'm very slightly in the plus, but that means at least I'm selling at a break even. Plus, of course, all the nice dividends that I pocketed in the meantime. So yeah, overall, it was still a good investment for me, but I just feel it's time for me to sell them off and shift my funds elsewhere. If we hop over to Seeking Alpha, which is my stock research tool of choice, we can have a look over here and see how realty income, for example, performed. You can see over the last year, it's still down actually, right? Even over a 5-year period, just by pure price, it's still down. Only on a 10-year period, it increased slightly by 37%. So in that way, you don't invest into realty income because of capital appreciation, but you invest because of the cash flow in the form of dividends. You can see right now it pays a dividend of 5.42%. So that's of course very attractive, right, for a lot of investors. And the great thing is they actually pay a monthly dividend. So I really enjoyed always getting that monthly dividend paid to me. You can see here on GetQuinn, which I use to track all my various portfolios, I'm getting right now every month $23 paid to me in the form of dividends. So really quite attractive. And basically for the whole of next year, if I see the total year, it will be $280 in the form of dividends just by holding some realty income. And obviously my holding is not that big. It's around 5.2K in dollars. This is all shown in dollars over here. So yeah, getting that on top is definitely very attractive from a passive income point of view. However, when we look at it purely from a capital appreciation, then it's obviously less attractive. And another thing that scares me a little bit is the short interest. So that's basically people betting against the share price or betting towards the price depreciating in value. And you don't want this number to be too high, because the higher it is, that means more people betting against the company, and you don't want too many enemies of the company, and that's actually on the higher side. Now, of course, one big reason why the stock price has dropped in recent times, you can see over here, just at the beginning of 2020, and the biggest part of that is, of course, the increased interest rates, to combat inflation. But basically, the high interest rates make it even more expensive to borrow money in order for them to acquire new real estate. And that's their whole business model, right? To borrow money and grow and acquire new real estate. So that becomes ever more expensive. Therefore, expansion is slowing down, and therefore the stock price took a hit. But of course, the question is, right, maybe the share appreciation is low, but what about if I factor in the dividends? How does it measure up then? And we can see that very easily over here on Seeking Alpha. If I go to total returns and I look at a 10-year period, and here you really see the reality of combining share appreciation or depreciation in the case of realty income, plus the added dividends. And we compare this to the S&P 500, the 500 biggest companies in the US, which pays a small dividend of around 1.2, 1.3%, really apple to apple. And you see, well, a massive staggering difference. The S&P in 10 years returned you 240%, which is really quite attractive. And honestly, that should be the benchmark. Anything less, it means you underperform the market. Well, if you would have invested into realty income, like myself, well, over a 10-year period, your return would have been less than half of that at only 115%. So definitely, you've really been losing out. Now, of course, you can see in recent months, it came back a little bit stronger, but overall, as soon as they started increasing the interest rates, it really took a deep dive. But even before that, it wasn't particularly outperforming the S&P, right? So in my eyes, even if eventually the interest rates will come down, which I'm pretty sure they will. In fact, there will be another meeting this week where they will talk about the interest rates, what will happen to it, even though personally I don't think it will be changed in this meeting, maybe in one of the coming ones. I do think this year it will be reduced down downwards, which will be really good for REITs, obviously, and it should boost their share prices. So technically, you could say I better hold on to them a little bit longer to benefit from the rise. And yeah, it would make sense, but at the same time, now that I'm in a slight plus, I actually think I might be better off by using that money and investing into something I'll talk to you about in a second, which I think will have even higher returns than those two companies or any REITs will have from benefiting from a lower interest rate. So I still think the other option that I will invest my money to will outperform those REITs. That's just my humble opinion. I might be wrong, but that's what I feel comfortable with. And I want to simplify my investments. Less is more. And this way I can really just dollar cost average into one position and let my money grow for me passively while I can focus on other things. And a similar case is true with Vici Properties, which is my second REIT, which is an amazing company, right? They basically own most of Las Vegas. A lot of the real estate over there is owned by them, and they then lease it out to some hotel or casino operator. So really profitable business model. But still, look at it. When I look at the last 5 years, yes, in terms of capital appreciation, they actually did better than realty income. It's also a smaller and newer company, so naturally there should be more growth. Over a 1 year period, it's still pretty much flatlined. Or year to date, since the beginning of the year, it's still slightly down. But then again, in the last month, you see a 10% growth because you're starting to see the indication of a potential interest rate drop. So as I said, once the drop will actually come, it may not move that much anymore because I'm starting to think it might be already priced in. So I don't think we're going to see a 30-40% growth because of the lower price point, because often these things are already priced in. Same, when you remember the Bitcoin ETF or Ethereum ETF, the news of such ETF coming out did actually more to the price than once we actually had the real thing, right? So often the news of a potential cut might be having a higher effect than the actual cut later on. In terms of dividend yield, also very attractive with 5.32%, and they pay on a quarterly basis, slightly lower short interest. I guess you don't want to be betting against Las Vegas. There will always be people gambling, probably even in a recession more so. So I think it's always going to be a good investment. That's why I also liked it when I invested at the time. And you see here the dividend growth over a 5-year period, 7.62%, a good payout ratio. So I like a lot of the fundamental values of the company. If I compare it to the S&P 500, unfortunately, Vici has not been operating for 10 years. They only started back in 2017. So that's why I can't show you the 10-year comparison. That wouldn't be fair. On the 5-year comparison though, it's pretty much in line with the S&P, slightly less, but not too bad. But yeah, if I compare it on a 1 year, for example, obviously you can really see the impact of the high interest rates, and then the return is really negligible. Despite the dividend, which is actually over 5%, the total return was only 4% because the capital appreciation was a depreciation. It was negative. So it just shows you altogether, it hasn't been really a profitable investment for many people. It's still a fairly young company. Maybe they will continue to grow and outperform the S&P. Personally, I don't think it will happen. But yeah, ultimately, I don't want to take risk and I want to make sure my capital and my money works for me, and I want to take any gambles and have to do all the research and spending my time following, what are the analysts saying, where the company's heading. So I think there's an easier way for me to go about it. As nice as those dividends are, you can see on a quarterly basis, I'm now getting $37 every quarter, which is nice to see. Next year in total, Vici would pay me $148. So really quite attractive. But ultimately for me as an investor, I really want to maximize my money. So I have to look at total returns, right? Even if I don't get any dividend, ultimately, how much is my money growing? That's much more important than if you get a 20% dividend, but actually the value of your holdings drops by 30%, let's say, right? So you're way worse off. So better not to get a dividend, but benefit from the overall capital appreciation of your investment. Or as a comparison, imagine you own an apartment that you rent out. You earn, let's say, 1,000 euros every single month in rent. That will be your dividend, right? It's nice to see. So you like it, very nice. But unfortunately, your apartment is in an area that's really going down the hill. The neighborhood is really changing. It's getting worse. People are leaving, selling their apartments around it. So the value of your house is actually dropping, which is happening, right? I mean, there's good areas and there's bad areas. So let's say the value of the house drops. Of course, eventually the rent might also drop a little bit, but let's assume the rent will still stay stable because there's a lack of housing. So your rent is being paid to you all the time, but all the while the value of the house drops more and more. So ultimately you might be actually worse off because the total value drops and the rent is not covering the loss and value of the house. So that's just something to consider. Of course, I still like dividend companies, but I just haven't seen too many that really outperformed the S&P 500, which for me and many investors should be really the golden benchmark against which you compare any kind of investment. And as I've shown you, I'm not talking about a 1, 2, or 5 year period. I think a 10-year period is really a fair evaluation to see how the performance of a particular stock or company is doing. Right, and that's why I will be selling both of them. So it's very easy. All I have to do is go into here and then click on close position. It will just pull up the selling order sheet over here. And yeah, I can see I want a market order type. The markets are open. Always make sure you sell when the markets are open. So that way you avoid that you get a different price, what have you. And then always click on preview. so I can see, what I will be paying. And I mean, a commission of 30 to 80 cents on such a big value, that's just attractive. And that's just another reason why I love Interactive Brokers. Really, really competitive pricing over there. And yeah, if I'm happy with this, I can go ahead, submit, and boom, the order has been executed. And if I go back into my portfolio, you can see it's already out of it. And now I have a higher cash balance over here, which you can see as well. And the same I want to be doing for Vici. So let's go ahead and go on close over here and pull up the same order sheet. Yep, I want to be selling everything. Click on preview. Once again, very low commission. This is the value I'll be getting, 89.7 shares, fractional shares. Always nice that you can have that on Interactive Brokers as well. I'll be happy with this. And boom, there you go. As simple as that. So of course, now that I have the money over here in USD, basically I buy everything in US dollars. I need to reinvest the money, right? I don't want to just have it sitting here in cash, because actually on Interactive Brokers, sadly, I don't get much interest on that. Actually, only from over $10,000, but still not as attractive as on some other platforms like Trading 212, where I would be getting 5.1% interest on my dollars. So yeah, here I want to ideally reinvest it right away. And of course, if you've been following my channel in the past, then you would know that I'm a big fan of the S&P 500, and that's why I want to reinvest those funds into the S&P 500, because that way I don't have to do all the work. It's passively managed for me, the 500 biggest and most successful companies in the US, and that is easy, set and forget it. I just buy it every single week, and I don't have to think much about it or do homework. So I really like that. That's why I'm going to be moving those funds into the S&P 500 over here. So let's pull it up. You can see already my holding, what I have, and I want to go ahead and buy some more. So let's click on buy, and I like to buy full shares, which currently equates to around 14 shares or 7.6K USD. Yeah, if I'm happy with this, let's click on preview. Now, sadly, because I'm buying the usage version of that ETF and it's listed in London, which is better for me because I want to buy it in dollars. However, the commission is slightly higher, around $4, which equates to around 0.05%, which honestly is really quite attractive. I'm fine with this, knowing that my money is safe on Interactive Brokers. Of course, there are some platforms, once again, like Trading 212 or even Lightyear, where you can invest into ETFs completely commission-free. Unfortunately, not all of them feature that particular ETF that I'm planning to buy over here. And once again, I just have my biggest part of my holding with Interactive Brokers because I really know my money is safe with there. They have such a long track record in history. So yeah, that's why I'm happy to pay that money over here. Just go ahead, click submit, and boom. Once again, I've done the order and my S&P 500 holdings has been increased. So yes, if I go back into my portfolio over here, you can see now I only have 2 positions left. SPY5 has been increased now to 93 position. Hopefully soon I have 100 shares of it. And then of course, Pfizer, as I said, a company to discuss another time. And there you have it. This really helped me clean up my portfolio, and I just find it easier. Once again, it allows me to focus on revenue generating initiatives and other things in my life rather than having to constantly follow, the earnings reports and so forth. While it's fun, I did that for a while, listening into them and following all the news. As I've shown you, ultimately the numbers don't lie, right? And the performance was just not there. As nice as it is to get the dividends paid to me, I enjoyed it, and seeing those dividends grow over time, ultimately it's the total returns that matter as an investor. If you really want to working on increasing your net worth, while dividends are nice, ultimately we have to be honest to ourselves and look at total returns. I think it's so much more important, and that's why I decided to go ahead with this decision. But I'm really interested to hear from you. Let me know in the comments what's important to you. You prefer dividends or you look at total returns? Next up, check out this video over here where I'm actually really going into the details and explaining you the difference between dividends, total returns, what it is, why it matters, and hopefully it will help you in making your own investment decisions. As always, thanks for watching, stay healthy, get wealthy, and I'll see you in the next one. Ciao!